Rais Farnawani, I have heard that you are entrusted by the management with a mission outside the country for a long period. Is that true? You are right, Ya Abu Cartoona. But I have become addicted to acting with you as an Egyptian cartoon character. You may act for Amr Samir Atef, the famous cartoon video script writer. You may also be in harmony with Bayomi Fawad, Badria Tolba, or Iman Al-Sayed as a co-actor or co-actress. When you do acting with them, you will be a video star within a short period. But continuing as an actor for me will cause your videos to be viewed by only 1 or 2 viewers a video a month. Look at what our godfather Naguib al-Rahani has said. I am nothing because I know Beta Elm, and Amash Beta K Labra Safragi. You are absolutely right, O Ustaz Hammam, sorry Rais Farnawani. Because this may be our last session together, what you are going to present today in connection with inventory? Today, we will talk about inventory errors. These errors may have a material effect on 1. Current assets, 2. Working capital, which is current assets minus current liabilities, 3. Cost of goods sold, 4. Net income, and 5. Equity. Is there a main or common cause of inventory errors? The inappropriate timing of the recognition of transactions is a common cause of inventory errors. Could you please give me a case or more for inventory errors? Okay, but your full attention is needed. I will give you the following 2 cases. Case 1. Assume that a purchase on account is not recorded and the goods thereto are not included in the ending inventory. In this particular case, the cost of goods sold, which is composed of beginning inventory plus purchases minus ending in inventory, is unaffected. The net income is also unaffected. But current assets and current liabilities are understated. I implicitly understood from using the word purchases and also how the entity arrives at its cost of goods sold in case 1 above that the entity uses a periodic inventory system. But I need to understand how the cost of goods sold and the net income remain unaffected whether or not a purchase transaction has been recorded. This may require an example. I have the same implicit understanding. The example is, a purchase on account is $500. Beginning inventory is $3,000 and ending inventory is correctly assumed to be $1,500. If a purchase is recorded and is included in ending inventory, 2 journal entries are to be made. 1. Debit purchases account for $500 and credit accounts payable for $500. 2. The closing entry should be, debit ending inventory account for $1,500. Debit cost of goods sold account for $2,000. Credit beginning inventory account for $3,000, and credit purchases account for $500. On the contrary, if a purchase on account of $500 is not recorded and not included in the ending inventory, journal entry 1 above is omitted and the closing entry will be, debit ending inventory for only $1,000, debit cost of goods sold for $2,000, and credit beginning inventory for $3,000. Thus, cost of goods sold in both situations is unaffected and remains the same at $2,000. As a result, net income is also unaffected. But both ending inventory account, which is a current asset, and accounts payable, which is a current liability, are understated by $500. It is clear to me now. But you mentioned earlier that there are 2 cases to discuss. What is case 2? Case 2 is as follows. If purchases and beginning inventory are properly recorded, but items are excluded from the ending inventory. Using the same example above, the closing entry is, debit ending inventory for $1,000, debit cost of goods sold for $2,500 and credit beginning inventory for $3,000 and credit purchases for $500. Compared with case 1 above, the cost of goods sold is overstated by $500, and consequently, net income, ending inventory, retained earnings, working capital and current ratio are understated. Can inventory errors from recording transactions in the wrong period may be reversed in the subsequent period? Yes, if ending inventory is overstated, overstatement of net income will be offset by understatement in the following year that results from overstatement of beginning inventory. Does the overstatement in current year-end inventory affect the financial statements of 2 different years? Yes, in the first year. The effects of overstatement of year-end inventory are as follows. In the balance sheet, ending inventory is overstated, consequently closing retained earnings is overstated. In the income statement, ending inventory is overstated, consequently cost of goods sold is understated, gross profit is overstated, and finally net income is overstated. What are the effects of the overstatement in the first year on the second year's financial statements? In the balance sheets of the second year, the inventory ending balance is correctly stated. Ending retained earnings is correctly stated because the overstated retained earnings at beginning is offset by the understatement of net income for the second year. In the income statement, inventory beginning balance is overstated. Consequently, goods available for sale is overstated, cost of goods sold is overstated, gross profit is understated, and finally, net income is understated. Thank you, Urays Farnawani, for your valuable time and for the knowledge you have transferred to me. All the best.